All right, guys. Thanks everyone for coming. This class is how to leverage the personal family budget. It's a follow-up class to the 6 steps of financial freedom. We did that class a couple of weeks ago. So if you weren't on that class, that's okay. You definitely want to get on that class in the future to make sure that you understand where this takes you. However, this is probably the most important piece of the puzzle. This is the piece that I've been missing for 25 years. I wish I had this piece of the puzzle 25 years ago. I wish someone told me about this a long time ago, and it would have probably changed my life. There's probably a good chance I may not be talking to you today if I would have known about this 25 years ago, because I may have had my financial freedom at that point. But here I am to help you guys learn where I made mistakes, and hopefully you can use it the same way. A little bit about my story, the bigger pile theory. I've been using this concept. Started doing this personal family budget about 3.5 years ago. I started saving. I had to save through my coaching program 20% of my net income every year since 2016. Once I started saving 20%, it was definitely difficult to get the money in there, especially out of your net income. The key is, from the 6 steps of financial freedom, the key is you always save first and pay your bills last. That's the key concept. That's different than most people's mindset is, I got to pay my bills first, and then whatever's left over, I can save. It doesn't work. So if you want to build wealth, you got to start saving 20% or more of your net income, and it has to be in the beginning of getting paid. And we'll go into that a little bit more. I increased my net worth by 35% in 3.5 years. That's a massive gain, you guys. Think about that, how that accumulated. 35% a year for the last 3.5 years. My net wealth has grown substantially, and it's all related to following the personal family budget and the concepts of the 6 steps of financial freedom. So just a quick review, 6 steps of financial freedom. First step is implement the personal family budget, which we're going to talk about today. And then the rest of this information was covered in the other class. Again, we recorded that other class, so we can send you the link to see that, or you can sign up for the next class that we have coming up in the near future. But it's basically do the personal family budget, get rid of your revolving debt, set up a survival account, invest in a 401k, invest in stocks and bonds, and then pay off your house at the end of the day once you're over 50. All right, so I'm going to jump right into the personal family budget. This is going to be more of a tutorial class than a actually, informational class, but you can certainly ask questions. So Jalen's online. If you have questions, shoot her a chat and let her know what your question is, and we'll try to answer those along the way. At the end of the class, once I get through the tutorial, I'm going to pull up an actual personal family budget, and I'm going to do some changes and stuff there as well, and there'll be another opportunity for you guys to ask more questions from there. Here's the key, the personal family budget. You guys hear about it. You got a budget. You got to do a budget. I mean, we hear about it all the freaking time. The problem is most people do not track their financial situation. And that's why America is in a mess of financial debt. Like, America is one of the most in-debt countries in the world. And it's because we spend money freely and we don't figure out where the money's going or how we got it in the first place. The personal family budget brings this all into clarity. You got to fill one out every month. The first of the month is when you want to do it, right around the first of the month. You can do it right at the end of the month or right at the first of the month, but you got to do it every single month. If you miss a month, it's going to throw you off and you're going to fall right back into your old habits because you're not going to know where you're spending your money anymore. The key with the personal family budget is knowing where your money's going. Get control of your money. If you start today, you will see massive gains, or see where you're spending, how much you're saving, and start building wealth. That's our problem, is nobody knows where to start. And this tool is so simple, but it does just push you forward into building wealth and getting your financial situation taken care of. Again, I've been going through life for the last 25 years, not caring, like spending money and not knowing where my money goes. But at the end of the day, I didn't have any money left, so I didn't save anything. And that's literally the biggest problem I made. The biggest mistake I made is I didn't save anything along the way. I did my 401k and stuff, you guys, but nothing else. So first thing is column 1. This is the name of the bill. So does everyone have their form? We emailed the form out before. Can you see the form in front of you? Pull that up if you can, just to have it if you want to look at it and ask questions. So this first column, this is column number 1 on the form. This is where you list out every expense that you have. You literally want to sit down with either yourself or your significant other. Definitely you both want to be involved in this, because if one's doing a budget and the other one's not paying attention, you're still going to run into issues. It's going to be tough. So you got to get your significant other on board with you to do this. And you need to sit down. You need to clear out a couple of hours for this first sit down. And you need to get all your credit card bills, all your bills, your bank statements in front of you. And you got to figure out every single kind of expense that you might have. So in this case, on this example, these are mortgages up top. Chase and BECU are the mortgages. Here's a credit card section where you put in if you have a credit card or not. And then down here are your monthly bills: electric, gas, cable, water. And this is the section I'm talking about that has to be super dialed in. You're going to have different expenses than the person next to you. You're going to have different expenses than I do. You got to go through your bills and your credit cards and find out where you're spending money. Now, you don't need to have a Starbucks bill in here, but Starbucks would go into spending money. Or you can go down to miscellaneous at the bottom, where you just put miscellaneous expenses that you can't group into one particular category. You just throw into miscellaneous. We're always going to have miscellaneous expenses every month. There's going to be something that comes up or changes, and we got to be able to make sure that we're accounting for that as well, because otherwise it'll throw our budget off, and it'll throw our savings off, and it'll change everything. So we've got to account for these expenses. And actually, I guess I take that back. You could have, if you have a Starbucks problem like I used to have, you could have a Starbucks line, I guess, is the bottom line. But you got to go through, find out what your bills are, what your expenses are, and make sure every single one of them is listed. I prefer to have as many listed out as possible so that I'm very specific on where my money's going. You could potentially grab one line and make it more all-encompassing. Like on groceries, you could include Starbucks with groceries if you really wanted to. The bottom line is you need to pick and choose what the categories are to work for you. So you must track every expense. If you don't see the category, just insert it. Monthly bills that are not able to pay off in full, like an auto loan, credit card, or mortgage. This is key, you guys. The balance would be input after the name of creditor. So this is right up here. Capital One, this person wasn't able to pay that, but balance off in full. So the balance goes here. They owe $45.34. And that's what the balance of that account is for that month. So you got your statement from the month previous. So like we're in July right now. If we're sitting down in July 1, I got my statement for July. The balance was $45.34. I would input it there. Column 2, so this is column 1 that we're just looking at. Column 2 is the minimum monthly owed. This is probably one of the most important columns just because you need to know what your monthly outgo is. It's so important. Most people do have no clue how much they spend in a month. And the key with this is our first step in doing the personal family budget is getting us financially stable. And the best way to get you financially stable is to set up an emergency account. But the emergency account is based on what your outgo is. If you don't know your outgo, you don't know how much money to put in the emergency account, and so on and so forth. So they're all interconnected. What we want to get to is this bottom number here, the $58.99. That is your survival number. That means, and this is really important, that number represents that if you lost your job today, you had zero income, period, that's what you have to spend on a monthly basis. So if you look at column 2 here, there's going to be some categories here that have zeros in it. House cleaning, taxes. So the only numbers that go in number 2 is the minimum monthly payment that you have to pay on an average daily basis. So like on this credit card, this person got their bill. The balance was $45.34. The minimum monthly payment was $89. That's the number you put in there. Because if you lose your job today and you have no money, you need to be able to at least pay your minimum monthly balance or your minimum monthly payment. Same with electric. Electric's going to be pretty standard. It's going to fluctuate, but you kind of get that number in when you get your first bill and you put in $350. Gas is $150. Water is $325. or excuse me, 200. Dry cleaning. This may or may not be an essential. It depends on how you operate. Like dry cleaning to me is not essential. Like if you lose your job, you're not going to be dry cleaning stuff, right? So this could potentially be a 0 number in here because it's not essential. It's not what you need to live on a daily basis. Cell phone, we got to have phones. Insurance, you got to have insurance. Trash, gas, you got to have gas to drive to your next interview. Groceries are obviously essential. I would leave doctor in there because people get sick and you need to go to the doctor. You have to have money set aside. So I feel like that's an essential cost. House cleaning is left blank because you lose your job. You're not going to have a house cleaner come in and spend $100 to get your house cleaned. You're going to clean it yourself. I mean, you got to go into survival mode, which is why it's called the survival number. It's things that you can do without if you lost all your income. Spending money, you still got to have money to spend. It would be stupid of us to think that if we lose our job, we just can stop spending money altogether. So you want to plan ahead that you have some extra spending cash for things that you need to have. So this person's got 200 under spending and 200 under miscellaneous. Again, miscellaneous is some extra spending as well. I like to pad this area and actually put a larger number in there so my survival number looks a little higher. It forces me to save more money so that my emergency account is a lot bigger. So the survival number. No, most people, if you ask them, hey, what's your survival number? I mean, one, they're probably not going to know what you're talking about, but two, they're not going to know what that number is. It's so important, you guys, to know what that number is. Because if you know where that is, that puts you in such a powerful position. All right, column 3, monthly total paid. So now this lines up with the 3rd row as well. This is what you actually paid. So in this column and column 2, here, minimum owed, like on the Capital One account right here, $89 is the minimum. But you can see this person paid more. They paid more than the balance. They're trying to pay their credit card off. So in column 2, you'd put the actual expense that you had on that bill. So for example, like right here, and it's just cut off a little bit, but the gas bill is normally about $150, but for whatever, it must have been the winter, let's say, and the gas bill came in at $217. So when you get your bill in the month, if it's more than $150, you could still keep your $150 in there because that's an average over 12 months. But if it's the wintertime and your gas bill's a little higher, that would go in column 2 here. So column 2 is going to have the actual amount you paid for the month.
Sorry, Jeff, column 3.
Oh, I'm sorry, column 3. Thank you. So here's a list of everything this particular person paid all the way down, and this is their total checks wrote. So this is their total outgo for the month. Now, if we go back, I wish I knew how to go back. How do I go back? Oh, sweet. So this is our survival number. This is the minimum we need to survive. This is what we spent this month. So obviously we spent a lot more money than we actually have as a survival number. So that's why it's really important to get that survival number dialed in, because in a day where you can't do 11,000, you need to know what that number needs to be so that you can survive. All right, column 4. This is a massive column. This is probably the most important column. This is a motivational column too. I think this is the one thing that really changed me is watching saving money. It just gets you so excited about building up assets and wealth and stuff. Even if it's $100 and then it comes into $500 and then $1,000, you watch it, it's a mental thing. After doing this for a couple of months, I just got so fired up about trying to save as much money as I can. It changes the way you look at what you're doing and it increases your savings. Tracking your expenses on this personal family budget motivates you to build in areas where you normally wouldn't be paying attention to because you don't see it. So total monthly saved is going to be inclusive of any money you put in savings, 401k, IRAs, stocks, bonds, anything like that, any transfers that happen in that particular month. It also includes debts. So in this example, the Capital One, this client put $189 in. They paid an extra $100 a month. Well, that means they saved money because they're paying above and beyond what the minimum due is. They're paying that debt down, and that's increasing their wealth because they have less debt. So because of that, we can include that in your totally monthly saved. The goal is to get that total monthly saved up as high as possible, at least to the minimum of that 20% savings that we want to hit. I keep having a thing pop up at the bottom here that I can't see sometimes. Drives me nuts. Go away. So this is a really great column. Once we get to the full form, I'll kind of show you guys how it works. But basically in here, we're going to want to actually input some of the stuff. Let me pull up one other thing here too while I'm at it. So you can see the whole, so this is the savings on the personal family budget over here. You can see how these columns right here in column 4. So this is $200. This person put $200 in a mutual fund. The 401k goes in tax-free, so that doesn't actually go into checks wrote, but it goes in over here, $358. Checking, this is the money left in checking after all your bills are paid. And then you've got a 529 plan that put money in, and Wells Fargo plan. So just to get an idea where the savings came from, these come out of here. They also go into the checks wrote here line, and we'll get into that in a little more detail once we get to this form again. Okay. Column 5 is your total of the paychecks. So this is really key too. It's your net income. We do not deal with gross income because you can't spend tax money that you've already gotten taken and given to the IRS. So we want to get the net income in there. But it's key to get every penny of your net income in this form. So for example, paycheck 1, what I typically do is I go into my Bank of America account and I pull up June 1st to June 30th, and I just look for deposits. And then I add up the deposits from my paycheck, and then my wife has a job and she gets her paychecks. I add them up separately. So paycheck 1 would be the total of my wife's paychecks. Paycheck 2 would be the total of my paychecks. Just the net amount, the amount that went into my Bank of America account. So I add them up. So if you get paid twice a month or 3 times a month or however you get paid, you would add up all the deposits in June to put on this personal budget for July. On the personal budget, this is an interesting concept because you're using income from June to pay bills in July. You're always a month behind moving forward. So like this $4,500 would be deposits from June. Now the other thing you got to look for is like, what if you get a refund in the mail? Insurance refund, 50 bucks. Any check you get, any kind of money you get, whether it's cash, maybe you get a birthday card from your parents and they give you $100. You would put it on this total paychecks side. It'd either be under miscellaneous. I like to label mine out. So if I didn't have a label here that was fitting for the deposit, I would add another, I would add another column or row, excuse me, and I would add it in right here. It's under rebate. I could put birthday money and put $100 in there. I want to know exactly where everything's going every month. And then you total up down the bottom. So here's your total income for the month, $11,060. So that's the net income. That's how much money went into your bank account last year. This number should match the total of that balance of deposits that I was talking about earlier. Like when I pulled up my Bank of America account and I do a search for all deposits from June 1st to June 30th, it should total up to be $11,060. Now, one other line in here that's key is savings. There are going to be times where you have extra expenses and you need to pull money out of your savings account or your emergency account. Say the car breaks down and your expenses go, and you pull that money out of savings to pay for the car fix rather than using a credit card, which is key. I keep looking over here because your pictures are over here and my screen's in front of me. So I'm sorry if it looked like I'm looking off to the side. The key with savings though, that's gonna be the deposit. You're taking it from your savings, put it into your checking. That's income in our opinion on this personal family budget. So under the savings line right, under the, oh my goodness. Under the savings line right here, if you transferred $1,500 from savings, then you add $1,500 in this line right here because that's income that went into your bank account that month. Now the thing with savings is it's never a negative number either. So if you take money out of your emergency fund account, your savings account, you don't take a negative savings for that month out of that account. It just ends up being a zero or it does come off of how much you put in savings. So say, for example, you were able to put away $2,000 into savings, but then at the end of the month, you had the car problem and you had to pull $1,500 out, your net savings would be $500. But if we say that you didn't put any money in savings, but you had the $1,500 expense on the car and you moved $1,500 over, it's not a negative $1,500 in savings, it's just zero. You can never go negative on savings because it's a positive no matter what. And I'll go through that one more time when we get to the actual form at the end. So this is an accuracy check. This is something you got to make sure is right as the bottom line. The total amount of checks wrote has to match the net income for the month. So the 1160 and the 1160 always match. Where it usually comes off on is the balance on your checking account, the 2294. That's the balance owed in your checking. It's the balance in your checking account. Mine's a little different here. It's 1794. But do you see how my numbers match on this form? It's 1160 and 1160. Now, if I came in and this one was 2700, now all of a sudden my checks wrote doesn't match. Normally, what I'll do, and it does happen occasionally where these numbers don't match, I take it out of the checking account. I lower my checking account because somewhere I didn't count for every penny, but there was expenses, and if this is higher than what I actually made, that money had to come out of somewhere, so it probably came out of my checking account. So then I would lower this down to 1794. Ideally, if you're doing this right, though, and most of the time, I balance here. Like just by following the numbers and making sure I have everything updated exactly the way it's supposed to be, these numbers should match at the end of the day. All right. Money market balance is the amount you have in your savings or money market account. So this is our survival number, you guys. This is a huge thing. We want to make sure that we have enough money in there to live for at least 3 to 6 months. I personally have over 6 months of reserves in my account just because of my business and ups and downs in real estate and I'm commissioned. I want to have a bigger balance in there just to protect me going forward. Most people that are like a W-2 employee, you have a regular job with an hourly rate or a salary or something like that, 3 months is probably enough. This is a key tool though. This is the lifeline. This is our saving grace that if anything ever happens, like the situation we're in right now, a pandemic. I mean, think about how nice it would be if we hit this pandemic, not that that could ever be nice, but how nice it would be to have 3 or 4 months of savings in the bank to help us get through this time. It's so important. I mean, luckily enough for me, I've been blessed to be able to be, working because it is busy out there real estate wise, but I still feel so good about the fact that I have a huge money market balance and my survival number is covered by immense amount that if the real estate market stopped today, I would not even blink an eye. I would have enough money in my savings account that I could pay all my bills every month without a problem for 6 months. Think about the level of security that can give you and your family. So important. And the nice thing is you want to keep that balance there. It motivates you to have savings, but then as you continue to grow that savings, then you can move that money as you go above and above or go higher and above the 3 times survival, we start moving that money into investments and start building wealth. So that money market balance, it's not just there to have money available. It's there as a security blanket. It's there as a financial, I can't tell you guys how amazing that makes you feel when you have money sitting there that's there for emergencies. It's going to change your life. So the money market float is 3 times the survival number. So we have our money market balance right now. This person has 35,800. Their survival number is 58.99. 3 times that number, this is automatically calculated in the form. 3 times your survival number is $17,697. So this number is 3 months. This is that number. This number should match or be higher than the 17,000. So in this case, this person has 6 months in reserves, so they could literally stop working today and continue making their payments on their mortgage, their cars, their credit cards, and all their bills without having to pick up a finger and be fine. They're protected. What an amazing feeling, you guys, to have that behind you and not have to worry about what if I lose my job or something like that. So this is a very important, it's probably the first step of creating that financial freedom, is getting that emergency account set up. Oh, we got two of them. This is my favorite number. This is the number that changed my life, is this little column. It's an auto calculation, so you don't have to calculate yourself, but it takes total monthly, how much you saved of your net income as a percentage of your net income, 38%. So this person saved 38% of their income. I mean, that's a massive number. We want you to save at least, like we started about, 20% of your paycheck every month, and that's your net. So, but what's changed, and this is what this form does, you guys, and this is, I mean, it's just amazing. I get giddy thinking about it, is once you see that number, this number go higher, once you see this number, the money market balance higher, you start getting more and more aggressive on trying to save. It becomes a game almost, at least it did for me, where it just motivated me even more so to watch my spending. Like, do I really need that extra Starbucks? Do I really need to go out for lunch? Do I really need to go out for dinner? Do I really need to go here or there or the other thing? I mean, it focuses you on in a different aspect of your life that's more important than any aspect, and that's building wealth and getting more financially stable so that going forward, you're safe. And this 38% number, every month I would watch that and I would get aggressive. I was like, I want to save 39%, or I want to save 40%. I want to beat my goal. Then you start looking at your personal family budget, and you're like, where can we cut more costs? Where can I save a little bit more money so that I can next month save 40% of my income? And some of you might be starting out at 5%. Some of you might go to 10%. You know, it doesn't matter where you start. It could be 0%. And some of you will start at 0% savings in a month. But it just depends on where you're at. The only thing I can say is you got to start doing this and do it every month consistently. And you will start to see these numbers go. It's going to show you where you're spending your money. I was stunned, like literally flabbergasted when I did my first personal budget to see where my money was going. It was awful. I was embarrassed. My favorite one was my Starbucks bill, which was massive. It was close to over $400 in 1 month for Starbucks. Of course, I use clients and stuff that too, but I just got in this habit of every morning I go to Starbucks, and even sometimes in the afternoon I go to Starbucks. And I take people out and blah, 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 this, that, and the other thing. And I was spending $400 a month in Starbucks. Like, who freaking does that? I immediately, like right now, my Starbucks bill is probably practically nothing. I mean, I got it down to under $100, and it probably is even less than that, $50 a month or so, because I changed the way I spend. I changed the way I did things from that standpoint because I wanted to save more money. So that's what I'm talking about. These examples are real life examples that I've gone through, that by doing this personal family budget and getting motivated by looking at how much you can save and build wealth, it will change your financial future. Year-to-date save, that's how much you saved year-to-date. This is an auto calc too on the form that we'll send you out. So every month there's a tab at the bottom, and you can start a new month going forward. And every month your savings starts to calculate and grow and grow and grow. And at the end of the year, you can save more and more money, and that just motivates you as well. So knowing how much you saved year to date is massive. It's great to know that you're on the right track and that you're building wealth. So that's a great number for me as well, motivation-wise. I still love the percentage one. That one just threw me off I just loved it, watching that percentage, trying to drive it up as high as possible. There was several months where I was at 50 to 60% of my gross net income in savings. Like, I got super aggressive. Like, my coach would motivate me to say, who's going to have the biggest personal monthly savings this month on your personal family budget? And whoever had the highest a month, the other two students on my call would have to buy the other person dinner. So it was just like, we analyzed the budget, we figured out where we could cut money out of our budget, and boom, we saved every penny that we could, and boom, we hit 50, 60% in some months. So you can't say you can't save until you actually know what you're spending, and then you can see how much you can actually save. I love this. If you haven't kept track of your savings in the past, don't worry. The best time is to start now. There's no better time to start, guys, than right now. And don't wait until the first of the month to do this. Get your personal family budget dialed in. Get your significant other, if you have one, dialed in with you, and sit down. And like I said, take a couple of hours to go through all your bills, your bank statements, see where you're spending money, and get this going. And then on the first of the month, then you start filling in the blanks. Current asset allocation, this is as your assets grow, you want to track them. They motivate you. We want to find out what your actual net worth is. And watching your net worth grow is an amazing motivator as well. Again, my coach would motivate us saying, who's the first one to get to this level on your net worth? Who's the first one to get to this level? I mean, motivate each other. Motivate your significant other, or motivate yourself by, hey, I really want to have, you know, this much money in my investments by the end of the year. Have a goal set and then use the personal family budget to hit those goals. Even better, if you have a significant other, or if you don't have a significant other, find somebody else to hold you accountable to this and watch the numbers for you as well, so that you don't get off track. You got to hold yourself accountable to this. If you don't have a coach, find a family member or find a significant other that can help, where one of you're each coaching each other. But just make sure that you're holding yourself accountable to getting these numbers up. You can see this particular person has a bunch of assets and they've been growing over time. But I'm telling you, these numbers, even if you have zeros in all these columns, by starting this personal family budget, you're on the first track to start filling those numbers in and watch those numbers grow. But this is where you fill out all of your individual asset accounts. If you have a 401k, this person's got a Fidelity account, a Wells Fargo account, and then they have an education account, and then they've got $75,000 in equity. Equity in the home, equity in rentals. This person doesn't have any rentals, so there's no equity put in there. This person's got a house. I mean, the equity is basically how much is the house worth, like pull up a Redfin value minus the balance of your mortgage, and there's your equity in the house. Cash net worth. So the cash net worth is a fun number again, watching that number grow. This is money that you have access to within a very short period of time. So this is stocks, bonds, 401k, IRAs, things like that. Cash net worth is a huge number because that shows you how powerful you are financially. So if you have a really low cash net worth number, it's not means, but use that to motivate you so that your number is, in this range and going up every month. And that's what this form is going to do for you guys. And this is an auto calc as well. So this number is auto calculated through the spreadsheet using the numbers on the previous screen from here. It'll calculates all these numbers up here for the cash net worth. Equity in a house is not cash net worth because you have to pull the equity out and you have to go through a process and it takes longer than a couple of days. So it's not considered in there. So the cash net worth is just the cash that you have. That includes the money market balance up here. That's part of your cash net worth, and then all your other assets. The total cash net worth, that includes the $75,000 in home equity or rental properties or anything like that. And that's a great net worth. I mean, geez, $473,000 is an amazing net worth for this person. And it just kind of shows you where you're at and where you want to be. Okay, giving seems odd when we're doing a personal funny budget and we're trying to pay off debt and we're trying to get financially free. Giving seems like it may not be the most logical thing to really focus in on in this form, but giving is really important. I think with the changes and even some of the stuff we saw recently in the news and everything else going on with our society, giving back to society, you guys, is really important. Especially for me, being lucky enough to work and stuff, giving is even more important to me. I'm successful and I'm busy. I want to give back to those people that aren't as lucky. And I feel like even in a bad month, and this is my coach, Rick Ruby, he told me several times, is even in a bad month, when you barely have any money to save, you still want to give, because giving always has that 360. It's always going to come back to you in good karma down the road. So giving is really important, you guys. We try to donate at least 10% of our income. It can be to your church. It can be to a special place that's really important to you. I mean, do what you can to give anytime you can. I think it'll just make our society a better place. It'll make you feel good. It makes me feel good. I mean, I don't think I do enough by any means, but it makes me feel good. And I feel like if everybody gave back a little bit that could, the world would be a much better place. So that's why the giving is on there. I think it's an important number, and you want to try and give as much as you can. I know my coach, Rick Ruby, he's a very wealthy man. He does really well. Last year, he gave away $2.5 million of his own money, net income. And he's a big giver, obviously. All right, guys, that's the last step on that one. So what I want to do now is I'm going to bring the personal family budget in. I'm going to go through some specifics. If you have questions right now, please send those to Jalen. Jalen, do we have any specific questions right now?
So the only one we have right now is if you are knowing that you're going to owe on your taxes at the end of the year, and you want to start saving for that, where would you put that in the budget?
So if you know you're going to owe taxes, like I owe taxes every year as well, you would put it down here and you would create a category as your monthly minimum owed. If you know you're going to pay taxes up front and it's going to be $3,600 at the end of the year, you'd put $300 a month here, and you'd have $300 a month here if you actually sent the money to the IRS as well. And or another place to put it is that if you don't know the bill's coming and you file your taxes on July 15th and you didn't see the money coming and it was a $3,600 charge and you had to pay it out of your thing, total checks wrote has gone up dramatically here. We just need to make sure that you had the income to cover it. But maybe we did a transfer from savings of $3,600 to cover our taxes. Now we're back to even. That's why that bottom line, column 3 and column 5 have to match. We got to know where the money's coming from.
All
so
right,
now I have
Jeff.
36. Go ahead.
Sorry.
That's all right.
I was just going to go into the next question, but did you want to finish up anything on this one? Oh, I don't know if you can hear me.
I can hear you.
Oh, okay. Perfect. Well, the next question that we had was, is it smart to pay off your house early?
I mean, no, in the 6 Steps of Financial Freedom, they talk about paying off your house. Once all your debt's paid and all you have is your house left and you're over 50, that's when you can start thinking about paying your mortgage off early, is when you hit over 50. That's the standard protocol. I just turned 50 this year and I went to try to start paying off some of my mortgage a little more aggressively. And my financial advisor told me not to do that, only because he feels like eventually we're going to come out of this pandemic and the stock market's going to be on a major roll. You don't want to be putting money towards a mortgage where the rate's 3% or lower and your house is appreciating maybe at 5 to 7% when you can put your money in stocks and bonds and maybe get 15 to 20% return on your money. So he's like, right now is not a good time because he feels like the market's going to get really good. So he's telling me to hold off on prepaying my mortgage off whatsoever. I mean, the key is when you're thinking about paying off your house, a lot of people have that vision where they want to pay their house off in full. They want to own their house off in full. But really that vision comes from probably my grandparents or my great-grandparents. Back in the recessionary, back in the Great Depression and things like that, there weren't laws in place for people on home ownership and banks and things like that. So they ran into a lot of issues with, they wanted to pay their mortgage off because if they missed one payment next day, that's how bad it was back in the 30s and 40s. So my great-grandpa and great-grandma, when they heard of other people losing their houses really quickly, they were super motivated. They wanted to pay their house off immediately. Well, nowadays, the situation with mortgages, I mean, if you go into foreclosure, you're going to have that house for another year before they can even touch you. So the mindset's changed a little bit. I think we still learn from our parents. Like my parents' house is paid in full. They were motivated to pay their house off. My mindset is there's no way I'm going to pay my house off. One, I'm probably not going to have it for 30 years. I'm probably going to sell it in the next 10. So why pay off my house if my house is going up in value anyways? And every time I make a payment, the balance of my mortgage is going down. Why pay off your house? Especially, and this is the rule of thumb, if you have any other debt, a car loan, a credit card, anything, student loans, I don't care what the debt is. If you have any other debt, that should be paid off first before you even think about your house. Then you should invest and make sure you have your 3-month survival account. And again, I would argue with anybody that paying off their mortgage even at that point doesn't make sense, that they should be plowing money into investments at that point. Once you have your personal family budget dialed in and everything looks fantastic and every month you're saving 20% plus, keep saving 20% plus. Make it 30% plus. Make it 40%. The goal is the stock market over the last 80 years has gone up 12.25%. The housing market over the last same period of time has gone up just over 3%. Where do you want your money? Do you want to earn 4 times the amount? Yes, we do. Just in case you didn't know the answer. Yes, you do want to earn 4 times bigger than your house. So there's no point in paying your house. For every dollar you put into your house, you're losing $4 in stocks over a long period of time, you guys. I'm not talking about you're going to put in $1 today and have $4 tomorrow, but in 10 years, you're going to have a lot more money in assets if you put that money into stocks and bonds and other investment vehicles than to pay down your house. That's the key. Any other questions right now?
Nope, not at the moment. But if anybody does, feel free to unmute your microphone and ask, or type your question in the chat, and we'll make sure that Jeff gets to it.
Can you hear me, Jeff?
Hey, Martha,
it's Martha.
how you doing?
I'm good. Good morning. So, I'm a budget analyst
Yeah.
with the government, and I just don't understand why can I not pay off this house? Because, I've always been, I follow Dave Ramsey. I follow you. I've done everything you told me to do, and it works. I have my budget sheet. Everything you taught me last year when you sold me my home, I have followed it to the T. I'm maxed out with my 401k, my Roth and all. So what is wrong with paying off the home? I'm just confused because I don't understand why should I stay in debt? Because I feel like I'm sitting up. This is the only debt I have right now. I have nothing else, Jeff. All my student loans, everything is gone.
That's fantastic. Well, I'd love to see your family budget. And just see
Well, I did what you told me to do, and it works. I just don't understand. And when you listen to Dave Ramsey, that's one of his steps: pay off the house.
Yeah, and I follow
and then
Dave
everyone
Ramsey
tells
as well.
me you lose the equity, you can't refund.
Yeah, I get it. The advantage is, like I just said, would you rather get 4 times your money or not? That's the key. On average, the stock market returns 4 times more than the housing market. The beauty of a house.
Right.
The beauty of a house is the power of leverage. And the wealthy get wealthier.
I need you to do a training on that, the power of leverage on the home, because that's what I don't understand. I'm ignorant to that, and I'm being honest. I need you to train me on that.
Well, it's the only asset you can buy where you don't have to put a lot of money down. You got your house with 0 money down, right? You walked into that thing with no money down.
Yes, sir.
And you're leveraging it.
That is correct, sir.
You got a really low interest rate with a decent payment, and there's no point in my mind to try and get rid of that mortgage because that asset is growing in 2 ways. Every time you make a payment, the balance goes down. And over time, the value is going to go up. The problem is that asset is only going to go up by about 3% a year on average. Seattle market's better, but just we're using averages. You could take that money that you wanted to pay. Let's say it's $500 extra a month that you want to put into your house. You take that $500 and you put it into a mutual fund that is going to average 10% over the next 10 years, which is probably easily possible. That $10,000 in 10, or that $500 a month in 10 years is going to be worth way more. House. You could turn around 10 years from now, take the money you invested, that $500 a month, take it, and maybe now it's worth, let's just say it's worth $25,000. Just random numbers. I'm just throwing out a number. You take that $25,000, now you could pay down your mortgage by 25 grand and be way further ahead than if you had applied the $500 a month to your mortgage every month. That's the idea behind leverage. There's absolutely no reason to pay off your mortgage early because you're leveraging the power of that money to invest it elsewhere. It's exactly what banks do. Think about a bank. You go put money in savings and you earn 0.1% return. The leverages it and then leases it out for car loans at 3 to 4%. They're tripling their return. We got to start thinking about acting like a bank.
Right.
We can be our own bank. We can use our own assets to leverage and become our own bank. We don't need credit cards anymore if we've got 30 grand in cash in an emergency account. You know, if we want to buy a new car, you can even pay cash out of that on your emergency fund and then build your emergency fund back up. You become your own bank using the power of leverage, just like the big banks do, just like the financial institutions do. They all leverage the power of their money. I mean, I work with certified financial planners. Actually, Brian Lockett, who is on our 6 Steps to Financial Freedom class a couple weeks ago, and he's a big proponent of this. He sends me clients all the time that are very wealthy. They have multiple properties, and they're always coming to me to do cash out refis. Pull 50 grand in equity out, give it to Brian, and Brian's going to give you a 20% return. That's how the rich get richer, people. They take their assets, they leverage them. They don't carry debt, but they leverage the assets they have, real estate and things like that, and they use that money to put it in assets that are going to grow at a higher pace. So that's why you don't want to pay off your house until you're much older. In my case, I don't think I'm going to die in this house by any means. And so if I want to retire in the next 10 years, I'm just going to keep making my payment, my normal payment, keep investing with the rest of my money. And at the end of 10 years, I'm going to sell this house and I'm still going to make out a ton of money. My balance will probably be another $10,000, $20,000, $30,000 lower on my mortgage, probably a lot more than that even. And my house will be up another, 10% in value over 10 years. Boom. I'm going to get that asset is working for me. You're always going to have a mortgage payment, more than likely. I mean, to pay off your house is going to take years and years and years, 10, 15 years. Why not use that time to invest because of the return is so much greater? A couple other things I wanted to show you guys. I'm sorry, go ahead. Okay, a couple of things on these credit cards. This is key. If you need to add another credit card in here, you just go over here, insert a line, then you can add a new credit card in here. Say we've got a Spark card. So I add in my Spark card. Let's say I can't pay it off every month, so I'm going to have a $3,000 balance. My minimum payment was $50 a month, and I paid $100. So now my savings is $50 a month over here. So I can still save. You see how that works? Like I'm paying over the minimum balance, so I can add this into the savings column that drops down here and increases my monthly savings. Now, if you don't have a balance, say I get my Bank of America every month, and the minimum owed on it is, let's say it's $50 a month. You still put a minimum balance on it or minimum payment on it, but then if I pay the whole balance off, let's say the balance was $1,800, that goes in this column. You still have to have a minimum payment in there, even though you're paying it off monthly, because you need to know what your monthly nut is. If tomorrow you quit your job or you get fired or get laid off, you need to know what your monthly survival number is. So even if you paid off monthly, you still want to put the minimum monthly payment on that statement that you got on there. Now, this isn't savings when you're paying it off monthly because it's not getting you anywhere. It's just a monthly bill that you pay off. So you would not add anything into month amount saved. You don't get credit for $1,750 in savings when you're paying it off monthly. You only get credit when you're getting out of debt. It helps motivate you to get out of debt even faster. So you can give yourself credit if you're overpaying here. If you overpay on a mortgage, you can get credit for it. Again, I don't recommend that, Martha, but you can. And if you do overpay your mortgage, you're getting out of debt, so you can add it in there. These are the only two I normally would never recommend overpaying. I just put this $330 in here as a savings. Plus, this is a HELOC. It's a revolving credit line. So that's a little different in my mind. It's not an actual, true mortgage. It's just a home equity line of credit, which is more like a credit card. So that might be a debt that I would focus in on paying a little extra to get it knocked out. But the mortgage, I would never overpay, in my opinion. Until you hit 50, and depending on where you're at, consult with people around you to find out if it's a good move. In my case, it wasn't a good move. My investment advisor highly recommended against it. He put some numbers together for me and said, here's why you shouldn't do it, and I'm not doing it. So we put the Spark in here, 3,000. We got that one in. You can add in as many debts as you want. Same down here. So like these are things that don't, like yard maintenance. If I get some guy coming in and he's mowing my lawn $25 a week and it's costing me, $100 a month, that's not considered essential. I can mow my own freaking lawn, right? So this column here, you guys, it's super important to only put debt in there or bills, monthly bills in there that are essential to living going forward. Think of it again. I lost my job. We have zero income. what are essential items that I need to have in my life in order to continue moving forward without skipping a beat. Like, I want you to be comfortable that you have enough money in your savings account that if your job ended today, it wouldn't even affect you for the next 3 months. You could pay all your bills, no problem. You wouldn't be stressed out about money or anything like that. That's what this column's for. So anything that's non-essential, like dry cleaning, non-essential, in my opinion. Insurance, depending on the kind of insurance, may or may not be essential. I mean, this is a pretty big number, so it must be homeowners and, or not homeowners, auto insurance. So auto insurance is obviously essential. You got to drive a car around, right? Trash is essential, gas, doctor, I mean, you could leave that in or you could take that out. I mean, I think it's essential in my opinion. If someone gets sick and you're off work, you're still gonna have to pay for a doctor, right? Or maybe if you have a copay or something like that. House cleaning, not. Spending and miscellaneous, I add a number in here all the time because I want a buffer. You gotta have money for spending. So I have a buffer in there. I think mine's actually a lot bigger than this because I want a big buffer. Again, I have my survival, my market float is way higher. I'm about 6 months, if not more than that right now. Now the cool thing is, you guys, this is my favorite part of this. I mean, I've got a lot of favorite parts of it, but as this money market balance grows and you start to save more and more money, it all goes in there. As that money market grows and it gets over your money market float, like this person has 6 months worth basically almost of savings. They may or may not want that. If it was someone that, if I had a salaried job at, let's say, Microsoft, and I felt really good about my job, that there's no chance of getting laid off, 3 months is fine with me. Once that money market balance starts to come up higher and higher, that's when you start moving money out of your money market into stocks and bonds and start getting a bigger return on your investment. That's when these numbers over here start growing. It's crazy how this works, you guys. Like, this balance here for me was easy to obtain. It didn't take me very long to hit my 3 months. And then I wanted to really have extra, so I went up to 6 months. But again, I got super aggressive because I started seeing this number going up. We started plowing, my wife and I started plowing money into this money market account. And then next thing we know, we had all this extra money and we're like, what do we do with it? I mean, we're like deer in the headlights, and it was like, time to invest, time to really start building wealth. And that's the key with a lot of people. 6 steps to financial freedom. I think the biggest miss in our country on investing and building wealth is missing out on the investment side of it, the stocks and bonds that return that higher return that we all need. One, we don't know. One, we don't have the money because we're not saving. We're not doing a personal family budget. 2, even if we had the money, we don't know what to do, where to get started. And then 3, I mean, we don't look at this every day. So we miss out on this whole thing of how to build wealth. And this is exactly where it is. And this account triggers that savings to grow and grow and grow. So it's a super important number to get those numbers dialed in and work towards growing the wealth that you can build. This form should document everything and put you in a great mindset to make things happen. Again, right now on this form, I've got it all screwed up because I have way more expenses because I made changing it. But this column and this column always should match. So what I would do in this case, if I was off for some reason, because we added the taxes in there that were $3,600 and stuff like that, we take 16,410 minus 14,660. Whoops. So that's 1750 minus 1794. So what that would do is go right here. I'd go down to $44 savings. Now 14,660 works, 14,660 works. The only place you can screw with this number is in checking because that's how much is left over at the end of the month. So if these numbers don't match, you just got to adjust your checking. And then you got to look at it and find out where you're off to make sure that your checking account, you're documenting every expense. You must be missing expense if those numbers don't match. And this giving is not an exact, you don't have to give, so that's why it's not in the essential spot either. But again, giving could be essential. You could put the giving here that you want to contribute $100 a month to your church, you know, $25 every weekend. You go in and you donate it. And that could be essential to you, and you can add that in. You can add anything in essential that you really want. mean, if you really need a nanny because you both work and you need a nanny, even if one of you gets laid off, you'd put the nanny in both columns, whatever that nanny is, or the babysitter that you need. If it's essential part of your life, then you got to save for it and make sure your survival number reflects that. I mean, once you have the survival number down here dialed in and your money market's covering it, oh my God, you guys, it's an amazing feeling. And again, then as you start to build this number up, you start putting money over here. All right, any other questions right now?
I have one, Jeff.
Yeah.
So obviously the idea with this is to not add balance to those credit cards, but let's say you're like in the hole right now and you don't have the emergency fund set up yet and something happens one month and you use the credit card. You just want to be honest with yourself. Where does that go on the form?
I mean, that's a great question. I mean, and part of this all stems back, guys, to the 6 Steps of Financial Freedom class, which would go over the more detailed part of this personal family budget. So if you have balances, like this person's got a balance here and I added this balance here, they would not be contributing money down here just yet. They would want to pay these accounts off first as quickly as possible. Their goal would be to funnel all their cash to pay off the credit cards first, starting with the lowest balance first and knocking it out as fast as you can. We had a discussion with Brian Lockett on that class, though. He did think that we should still invest in 401k because it's free money, especially if you have an employer match, that you can still invest in the 401k up to the employer match because of the free money and that it's tax-free, but you wouldn't build this account up just yet. And the reason for that is if you start saving money and trying to pay this off kind of half rather than full payoff, like fully aggressive, like you were saying, Sky, like if all of a sudden you're not out of debt yet and you need to use your credit card again, you still want to be fully focused on paying that credit card. Yeah, it sucks you have to use your credit card and bring the balance up again, but you still want to be focused in on trying to pay that credit card back off as fast as possible. So people first starting out in the 6 Steps of Financial Freedom, their first thing is to pay off all their credit card debt. That's the first step. It's not saving or anything like that. It's being super aggressive to pay off the credit card debt, which is a lot like Dave Ramsey. Again, there's certain pieces of this plan that are different than Dave Ramsey. Dave Ramsey's more aggressive in paying off all your debt, and he misses out on a ton of upside gain in stocks and bonds. That's why you don't pay off your house. Does that make sense, Guy? Did I answer the question?
Yes. Yeah, that's perfect.
But yeah, this person would not be saving this money down here, so I apologize. It's not a perfect example. I just wanted to have some columns filled in. This person would be more aggressive up here. So instead of throwing $200 in here, and let's see, Wells Fargo looks like another savings account. You know, instead of throwing that money in here, they would be paying, you know, $1,000 here. And then they could add in this to be whatever 1,000. Can't believe that's not formatted in there. So this would be about 900 here, let's just say. So then they're still doing the savings, but they're saving money on paying off their debt instead. Does that make sense?
Jeff, in that last example, wouldn't that not be a 900 because you're paying off the debt?
Well, if it's credit card debt, it's okay to amount saved as long as it's credit card debt because you are saving money and we want to motivate ourselves to pay off all our debt as fast as possible. So in this case, since we're not paying off the whole balance monthly, it would be a savings. On this one right here, Jalen, Bank of America, they're paying the full balance off because there's no balance here, right? So the balance on the Bank of America statement was $1,800. This person paid that account off in full. So you're not necessarily saving because you got the statement and you paid it off in full. Now, if you got this one here that had a 4534 balance and you've been carrying a balance on it, and then say maybe you got a bonus or something and you could pay it off in full, that could be a savings in that scenario, but only in that scenario. So like if this guy came in and did 4534 and you got a bonus and the income over here was like miscellaneous 4534, then it would be money saved because now instead of carrying a balance on this card, which you were at the beginning of this month, you no longer have a balance on it. It's paid off in full. So you just saved yourself $4,000 in paying interest on a credit card bill.
Okay, awesome. That makes sense.
All right, guys, I've got to fly. I went over my time a little further. I apologize. Again, this is more of a tutorial class, but if you guys have more questions, feel free to email me directly and we can address them. you even want to get on a call with me for a short training session to go through it once you have your budget set up, or if you have questions getting into your budget, I would love to talk to you about it. I mean, I've been doing this again for about 3.5 years and it changed my life, and I want to help you change yours. So if you're interested, just reach out to me anytime. And we can go from there. But thank you guys so much for coming on. I hope you learned something today, and good luck on changing your financial future and building wealth.
Hey, thanks so much, Jeff.
Thank
Thanks,
you.
guys.
Thank you, Jeff.